Hi, I'm David Giarchodi, Editor-in-Chief of WealthManagement.com, the digital resource for rep and trust and estates. And with me today here at the Chicago conference of Morningstar's annual conference, I have the legendary Dan Fuss, who is the who runs the flagship Loomis Sayles bond fund, and I believe you're vice chairman of the firm as well.
I am, David.
Well, I thank you for taking time to sit with us. I am curious, you've run that bond fund since forever.
Right.
1970 something, right? Did you?
Well, the bond fund itself was started in 1991.
Okay, but you've been at Loomis Sayles since 76. I mean, you've seen a lot of different cycles and all that. I just found it interesting that you recently, or for a while perhaps, have been saying buy stocks.
Yes,
and
certain stocks.
Yes. What kind of stocks?
Well, it's really the companies behind the stock, or the companies issuing the stocks, dominant companies in areas of somewhat above average growth that are paying reasonable dividends, where you have pretty good assurance that the dividend is going to rise over time. Now you say, well, out of how many hundred? Well, no, you get down to less than 10. Then periodically, the list gets bigger. It depends on what the stock market's doing. Late last August, first part of September, there you go. Today with the stock action, it's possible that one or two of these will be in that range. They tend not to be very volatile because there is this upward tilt to the dividend.
Right. Can you name industries or sectors, or?
Well, it's within industries. It's never across an industry. You're likely to find them in areas that you would normally look for above average growth. Technology, for example, but that's been really, really rare over the years.
Right.
But last August, early September, Intel fell into that zone.
Right.
These are companies with very strong financials, solid balance sheets, growing businesses, and they have a lower unit cost of making whatever it may be. And that's good. They also tend to be certain industrial suppliers. Got to be careful, and once in a while a consumer's non-durable producer.
Right. So you've positioned your fund for an eventual kind of debacle in bonds, I guess?
No, it's actually...
Is that too strong a word?
Yeah, I look on it more as good news, David. In that reinvestment returns will rise.
Okay.
You say, well, that's a shorthand of saying bonds will go down in price. Bonds outstanding right now will, until their ultimate maturity pulls them back up.
Right.
But as you reinvest, if it's a cash flow positive portfolio, you'll be happy. But don't run out and buy 30-year treasuries, worse yet, 30-year zeros. Back in.
What about tips?
With a lag. With a lag.
Aren't they negative? Aren't they? You're paying the government to take your money?
Right now. You have to, again, be careful with the terminology, but tips, in my mind, at the moment, are very pricey. From a longer-term view, there will be a time to buy tips.
Right.
This is not it.
What about the dollar? I noticed that reviewing your fund, you had, I believe, sort of bet against the dollar, but it's been... Isn't that right? You guys had
70.
I mean, let's put it another way. You had non-dollar denominated assets.
We do. We do. 70% of the fund, the bond fund, is in U.S. dollar pay.
Okay.
Another 11% or so is in Canadian dollar pay, which tends to track fairly close. Has an upward bias relative to the U.S. dollar. And the balance of the portfolio is in other currencies, but concentrated where you have a strong set of fundamentals. Now, that doesn't mean that they won't go down relative to the dollar, and of course go up relative to the dollar. They won't correlate with the dollar.
I see. Do you, if you're, what's your advice to a financial advisor? You've got clients who need yield. where do you go?
Back in history.
Yeah.
David, it is frustrating.
Yeah.
Running a bond fund, it's frustrating.
Yeah.
We've been able to keep the monthly dividend up on the bond fund. Okay. If rates go lower yet, oh boy, probably not. Total return will look wonderful, but the reality is you're reinvesting at lower rates.
Yes.
We can do better than treasury rates, that's no trick.
Right.
But the general array of interest rates is really quite low. Corporates are a whole lot better than treasuries right now.
What about dividend yielding stocks? Those
Yes.
are getting kind of pricey though, aren't they? Some of them?
Yeah, lately it's come into vogue,
Right.
recent months. Today it seems to be correcting a bit, but there is recognition that on a present value basis, a lot of these stocks, a handful of them, make more sense than high quality bonds. They do have a little bit of trouble competing with medium quality, medium rated bonds and high yield.
What about high yield? Do you own some of that?
Oh yeah. The fundamentals for high yield have been really wonderful, have been.
Yeah.
They're starting to change. It'll probably be some time, but you have to be careful. And in particular, you have to look out for the credits where they need to refinance on a steady basis in the future.
I see.
Those I would back away from.
Right. And one last parting question. What do you say about going long Italian sovereign debt? There's some yield or Spanish.
Relative to the U.S. dollar, David, the interesting thing, because you're correct when you say that, in current terms, longer term, the yields on Italian government debt are actually quite low.
Really? Wow.
Relative to history. They'd be low relative to U.S. Treasuries.
But you guys are not getting in there, are you?
Italian government debt? No, not at this moment,
Right.
not at these prices. And will the country survive? Yes, of course it will. Will they stay in the euro? Probably, unless the whole thing comes apart. So I have to be careful. I have a lot of Italian relatives.
Me
here.
too. I do too.
But are they in the same worry category as Greece or anything close to it? No, they're not.
Okay, well, I thank you very much for
Thank you.
sitting with us today at the Morningstar Conference. David Giariccioti with Dan Fuss at the Wealth Management booth at the Morningstar Annual Conference. Thanks.